Welcome to The Explainer. Today we're talking about short selling, one of the most fascinating, controversial, and frankly misunderstood strategies in finance. We're going to deconstruct it, consultant style. Not just the what, but the how, the why, and maybe most importantly, the massive risks that make this such a high-stakes game. Let's jump in. So, here's how we're going to tackle this. We've got 5 parts. We'll start with the core concept, then we'll get into the actual mechanics of a trade. After that, the strategic playbook. Why would you do this? Part 4 is a deep dive into the risks, and this is crucial. And finally, we'll ground it all with a look at the rules and a real-world case study that you won't forget. So that leads us to the big question, right? It feels completely backwards, betting on something to fail so that you can succeed. But if you can get your head around that paradox, you're on your way to understanding short selling, a strategy where both the potential rewards and, well, the potential for disaster are just enormous. Okay, let's dive right in. Section 1, the core concept. We need to build a really solid foundation here. So what exactly is short selling? The key word here, the one to focus on, is borrowing. See, you're not actually buying anything. You're borrowing someone else's shares, selling them immediately at today's market price and pocketing the cash. The whole bet, the entire play, is that you can buy those exact same shares back later for a lower price. You're basically flipping the classic mantra of buy low, sell high on its head. Here, you sell high first and then you pray you can buy low later. That gap between the two prices, that's your profit. So these points really get to the heart of a short sale. The first 3 are the basic mechanics. You're betting on a price drop, so you borrow, sell, and aim to repurchase. Simple enough. But it's those last 2 points that really define the experience. A high risk/reward ratio and the ever-present danger of something called a margin call. This tells you right from the get-go that this is not a passive strategy, it's an active, high-pressure game. All right, moving on to section 2, the mechanics. Let's get into the weeds a bit. How does this actually play out step by step in the real world? This really maps out the whole life cycle of the trade, from start to finish. It all starts with setup. You can't do this in a regular account. You need a margin account, which is basically a credit line from your broker. Then comes execution. Your broker finds the shares for you to borrow, and bam, you sell them. From that second on, your position is live. Which brings us to monitoring, because you have to watch it like a hawk. If the stock price goes up instead of down, you're in trouble. That triggers the risk of a margin call, where your broker calls you up and demands more money to cover your potential loss. And the trade isn't over until the final step, closing, when you go back into the market, buy the shares, and return them to whoever you borrowed them from. Now, here's something you absolutely have to understand. Unlike buying a stock and holding it, a short position is a position that's constantly costing you money. You're paying interest on that margin loan. You might have to pay special fees if the stock is really popular to short and hard to borrow. And this one trips a lot of people up. If that stock pays a dividend while you're shorting it, you have to pay that dividend out of your own pocket to the person you borrowed the shares from. All of these costs mean there's a clock ticking. Time is literally money here, and it is not on your side. Okay, so we've covered the what and the how. Now for the really interesting part, the why. Why would anyone do this? Well, it really boils down to 2 very different strategic motivations. This lays out the 2 mindsets perfectly. On one hand, you've got speculation. This is the aggressive, headline-grabbing stuff. You've done your research, you think a company is massively overvalued or maybe even fraudulent, and you're making a direct, offensive bet to profit when it falls. But on the other hand, you have hedging. This is a purely defensive move. Say you own a big portfolio of tech stocks. You might short a tech index fund, not to make a killing, but to cushion the blow if the whole sector suddenly goes down. It's offense versus defense. Okay, let's put some numbers to this. Picture a simple winning trade. You think XYZ Corp is way overvalued at $50 a share. So you borrow and sell 100 shares. Instantly, $5,000 in cash appears in your account. A week later, you're proven right. The company releases a terrible earnings report and the stock tanks to $40. You then go into the market, buy back those 100 shares for only $4,000, and return them. That $1,000 difference minus your costs is your profit. But of course, what happens when it goes the other way? Let's say you short those same 100 shares at $50, but instead of bad news, a competitor comes out of nowhere and announces a takeover offer at $65 a share. The stock doesn't fall, it skyrockets. To close your position, you are now forced to buy back those shares at the new, much higher price. So you sold for $5,000, but you have to buy them back for $6,500. That's a $1,500 loss. And that losing example? It's the perfect lead-in to Section 4, which is, honestly, the most critical part of this whole discussion, the risks. Because when short selling goes wrong, it goes wrong in a way that is totally unique in the world of investing. So let's just lay it all out, the pros and the cons. The pros, you can see them. They're pretty attractive. High profits are possible, you can get started with less capital, and it's a great tool for hedging. But then you look at the cons, and a couple of these are just terrifying. The risk of a short squeeze and this idea of potentially unlimited losses. Let's dig into what that actually means. And this visual right here, it says it all. This is maybe the single most important concept to grasp about the risks of shorting. It's called asymmetric risk. When you buy a stock, your downside is capped. The stock can only go to zero. The most you can possibly lose is 100% of what you put in. But when you short a stock, your upside is capped at 100%. But your potential loss is, mathematically speaking, infinite. There is no limit to how high a stock's price can go, which means there is no limit to how much money you can lose. And that terrifying idea of infinite risk, it has a name. It's a phenomenon that is the absolute waking nightmare of anyone who has ever shorted a stock, the short squeeze. Think of a short squeeze like a trap. It's this vicious, self-fueling cycle from hell. It starts when a stock you've shorted begins to rise for some reason. The short sellers are now losing money. To stop the losses, they have to close their positions. And how do you do that? You have to buy the stock. Well, all of a sudden, forced buying pressure pushes the price up even more, which causes even more pain for the other short sellers, forcing them to buy back their shares. And on it goes. The very act of trying to escape is what fuels the fire that's burning you. Okay, final section. Let's bring all this theory down to earth and look at how this all works in the real world, with regulations and a case study of what happens when things go catastrophically wrong. So, you might be thinking this is just the Wild West, but it's not. The SEC has put guardrails in place. A big one is Regulation SHO, which basically says your broker has to actually find real shares for you to borrow. This prevents something called naked short selling. There are also more and more rules coming out for big players to report their short positions for the sake of transparency. And in a real crisis, the SEC has a big red button they can push to temporarily ban short selling in a stock to try and calm things down. Now, if you want the ultimate cautionary tale, look no further than the Volkswagen short squeeze back in 2008. The story is a bunch of hedge funds thought VW was overvalued, and they built up massive short positions. What they had no idea about was that Porsche was secretly buying up shares in the background. Then, one day, Porsche dropped a bombshell. They announced they controlled over 70% of the company. Absolute panic. All the short sellers stampeded for the exact same tiny exit door at the exact same time. There were almost no shares left to buy. The price just exploded, going from about 200 euros to over 1,000. And for a brief moment, it made Volkswagen the most valuable company on the planet, wiping out tens of billions of dollars for the short sellers. It's the perfect lesson that you can be right about a company's fundamentals, but if you get the market mechanics wrong, you get wiped out. But, for all the horror stories and the bad press, it's really important to understand the other side of the coin. A lot of serious economists and market experts will tell you that short selling, despite its reputation, is absolutely vital for a healthy market. It helps keep prices honest by letting the skeptics in the room have a voice. Short sellers have uncovered major frauds, and the theory is that their presence makes the entire market more stable and efficient. So that's where we land. We've seen how it works, why you do it, and how badly it can go wrong. And it all boils down to one final question. When you know that catastrophic, even unlimited loss is a real possibility, is short selling a rational, calculated strategy for a sophisticated analyst? Or is it, at the end of the day, just a gambler's folly, a high-stakes bet against the general tendency of the market to go up over the long term? That's the core debate. Thanks for joining me on The Explainer.